Welcome back to another episode of Policy and Profits. I'm EJ Antoni. I play an economist on TV. More importantly, I am joined by the one, the only trader extraordinaire, founder of Ascalon Capital, Anthony Esposito. Anthony, how you doing today?
EJ, thank you very much, sir. I'm doing well. It's been a very exciting week. We're heading into our final push in the fundraise for Ascalon 6 Capital. We're actually traveling next week. We are funding in December, launching Jan 1. So we are excited. We have some fantastic partners and investors in. Still adding to that list, but things have been good and there has been a ton going on. I know you're back to the grind in DC. I saw you a couple of weeks ago. I know you've been very busy. What has your week been like? What have been the highlights? Where are you at?
Uh, been another insane week, that's for sure. To New York and back 3 times, if you can believe it. So it's been a little busy, but it's always good to get to. Well, I was going to say Manhattan, some parts of Manhattan, because
Yeah.
some are better than others. But
Yeah.
I digress. It's been really busy with the Fed, and exactly as we discussed a couple times, really all the different signals that we had picked up on, whether it was, secured overnight financing, the volume and the rate there, looking at the repo markets, we had all these different indicators that said, you know what, the Fed's going to have to stop QT. They've built this crazy monetary framework and they refuse to let it go. It's only a few years old, right? They started in 2020, but they
Yeah.
refuse to let it go. So the market's going to force them into ending quantitative tightening. They're going to have to stop running down the balance sheet. And sure enough, that's exactly what happened. We got not only the 25 basis point cut that everybody had priced that in, right? I think that's fair to
Yeah,
say.
the market had a 98% chance odds of it
Right.
of the cut heading
Exactly.
into it. So
Exactly. So we got that. But I think what a lot of people completely missed was, again, this end of QT, which is now going to happen December 1st. One of the really interesting things I thought, though, that I saw, Anthony, thinking about it more and more, the way the statement is worded regarding that, they're not going to run down the balance sheet anymore. But what they are going to do is they're going to let the MBS, the mortgage-backed securities, mature, and then take those proceeds and throw them into treasuries, specifically treasury bills, beginning in December. But what's really interesting is also in December, they're getting rid of the $35 billion cap. So right now, let's say the Fed has a tranche of MBS, $100 billion that matures this month. Right now, what they're doing is they're letting 65 billion of that, when it matures, get reinvested into MBS, and only up to 35 billion is what runs off. In other words, the money's gone. Poof, right? Like that South Park meme. Poof, it's gone. So what they're by getting rid of that cap, though, what it means effectively, unless there's a mistake in the wording, what this would mean is now when that $100 billion tranche matures, all of it is going to get reinvested into treasury bills. So you might actually see an acceleration in how fast they're running off MBS. And coming from the derivative world, if you reduce the demand for a financial derivative, you're going to reduce the demand for the underlying asset. Well, what's the underlying asset for MBS? It's
yeah.
mortgages. So you might actually, as a net result from all of this, sorry, this is a bit long-winded,
Yeah.
but you might end up actually seeing the average interest rate on mortgages go up, not down. It's not just a matter of they cut the benchmark interest rate. It's a matter of there's no way to soak up all of the supply of MBS anymore.
Hmm. Okay.
It's
So
crazy. I mean, it's they're talking about cutting rates, right?
yeah.
And we expect, okay, we're going to see consumer rates come down. We're going to see rates for businesses come down, rates on treasuries. That's not necessarily the case. We talked about back in the fall when they cut rates right before the election,
Yes.
right?
Yes.
And what happened to the 30-year mortgage? The yield went up.
Yep. Yep. 10-year yield went up, 30-year mortgage went up. They're not managing monetary policy or the balance sheet properly. This is
Mhm.
definitely it's definitely an issue. It just speaks to Powell's incompetence and the poor management at the Fed. You are actually out. We're going to skip to um, a later graphic. You were out talking about the Fed balance sheet and the fact that they're actually encouraging banks to lend them money and not lend money to consumers. Let's just call it in the US. So by doing so, they're actually keeping rates for the consumer and for the US higher in reality than they would be if the banks were not lending the Fed money and getting paid for it. And by the way, you go into this pretty well as far as even a good portion of those banks are international banks that our tax dollars are actually paying them
Yeah.
to lend the Fed money and reduce liquidity. I want to pull that graphic up. It was you on X chatting about it on Kudlow, and then we'll come back to it.
Larry, on the Fed, what they should be doing. I'm still a firm believer they shouldn't be trying to lead markets around by the nose. They should be following markets. They shouldn't even be trying to set rates the way that they are. Instead, they should be reducing the balance sheet much more quickly than they are. And they do that by stop paying banks not to lend money. Yes, you're going to reduce liquidity in theory by selling off a large portion of the balance sheet. But again, if you stop paying banks to lend to the Fed, they'll lend to the market. They'll lend to the Treasury. That'll bring down interest rates on things like your mortgage. It'll bring down interest rates on things like Treasuries. Yes, I understand it's ending the gravy train for Wall Street, but I'm sorry, it's about time we did that.
So now I'm just going to say this, and then I want you to dig into it a little bit more. Not only are they're not stopping paying banks to lend them money, they're using our tax dollars to pay out to the banks for them lending the money, and that money is going to foreign banks and U.S. banks. But now on top of it, they're going to actually flush the market with mortgages, and now that is going to put pressure on those mortgages down, which is going to increase mortgage rates. So essentially, they're keeping rates high as they're now trimming the Fed funds rate.
Yeah, exactly. For certain private market rates, you're 100% right, Anthony. You're gonna actually see those stay sticky, unfortunately. And I mean, basically, I get a lot of pushback when I say that this is costing taxpayers, right? And I understand when people say like, okay, well, actually, right? Like it's not as if the taxpayer is writing the check directly. But here's the problem, and this is the important thing. This is where kind of the rubber meets the road with monetary policy. Normally, the Fed earns a profit on its operations, okay? And it takes that profit, if you will, they call it remittances, and they send it over to the Treasury. And that supplements tax revenue, obviously. The Treasury uses that like any other kind of revenue. But every time there's a shortfall where the Fed doesn't send as much over to the Treasury as was previously anticipated, and there's a couple reasons why that has happened briefly in the past, but it always has to be made up for then by the taxpayer.
Yep.
What's unique today is that it hasn't happened briefly. It's happened since, I think, September of 2022. The Fed has been in the red, not just that they're not sending as much money as anticipated. No, they're not sending any. And now they're going to have to make $250 billion in profit just to wipe out their losses before they will actually start sending money again to the Treasury. That's a real loss for the taxpayer. Yeah. I understand it's indirect. I understand it's not as if it's a direct cost to the taxpayer, but it's still an indirect cost, which frankly makes it a cost nonetheless, right? And the fact that this is all going to, as you rightly pointed out, to paying banks, paying these financial firms, a lot of which aren't even here in the country. They're overseas, for crying out loud. This is a cost being borne by the taxpayer, and it's benefiting major financial firms, including foreign ones. This should be a major scandal. That is absolutely appalling, and it's no way to conduct monetary policy. They're so hyper fixated on this new monetary framework they tried to build in 2020, where they just basically focus on the financial plumbing and liquidity. And, do we have enough reserves relative to other parts of banks' balance sheets? Do we have enough bank reserves relative to GDP? And this is where you can look at all these different ratios and say, okay, writing's on the wall, QT's over. They're going to have to go back to printing money because they need to rebuild bank reserves. They need to get those numbers up. Yeah. And the only way to do that under the current framework, again, is just printing money, unfortunately.
Printing money with the debt and the deficit spending we have, inflation. Right. So
exactly.
Don't say that it's not a taxpayer burden. It is. Whether our tax dollars are going directly to it, or you're destroying the value of the U.S. dollar based on your monetary and your balance sheet policy, where our take-home checks are worth less. Either way, we're getting hurt because of your incompetence, and that's really where we're at.
Right. And if you look at the fiscal side of things, I mean, there's no reason monetary policy should be behaving this way. We basically had 5 years where you can say, okay, there was the fiscal side that was basically forcing monetary policy into printing all this money, right?
Yep.
Today, though, you're actually seeing the deficit come down.
Mm-hmm.
If you look at the last fiscal year that just ended, ended September 30th, right? The first 2 quarters, which obviously overlapped with the Biden administration, it was essentially the worst start to a fiscal year ever, even worse than the fiscal year that began in October of 2020 when you had all that blowout COVID spending. So, okay, get rid of the 2 quarters that overlap with the Biden administration. Just look at the 2 quarters when Bessent was at the Treasury, and we saw a massive decrease in the deficit. Only 25% of the deficit happened in those 6 months. So we're actually doing really well now in terms of reducing the deficit. It's the fact that you had so much hangover from spending programs that hadn't yet been canceled. So what I'm trying to say here, Anthony, is just that the fiscal space is in such better shape right now than it was a year ago, and yet the Fed is pretending it's exactly the opposite. Because again, they're just I'm sorry, I sound like a broken record, but they're just so hyper fixated on the wrong thing right now.
Yeah. Yeah. Well, I think there really is a lack of either a lack of understanding or nefarious action going on at the Fed, and it rolls right up to Powell. So I don't know what they're looking at or what they're doing, and I certainly couldn't do the job, but he certainly can't either. And it's a scary thought as a trader and a hedge fund manager to say that I could go to the Fed and actually, I would just call you and say, hey, EJ, what should I do here? you want to help me?
You could shake the magic 8-ball and you'd be right more than Powell.
Well, all answers point to yes. I'd be like, EJ, I wrote this statement. I'm actually going to read it tomorrow, like, I don't know, 3:00-ish Eastern time. Could you review it for me? All right. So let's shift off of Powell because he's, we often compare him to Mr. Magoo, and that's probably an insult to Mr. Magoo. I want to shift to China and the trade deal. And I want to do it in a very pointed way, right? So we had a graphic up. You and I were talking before about kind of the talking points and the main points of what the negotiation process was there. And I have just a very top-down view on what Trump pulled off this week in Asia, which to me was pretty amazing. But if we look at what the issues were going in, and China obviously it's a massive, what is it, $700 billion in trade between the two nations, where they're obviously the surplus nation there. Essentially, we need China to buy. We don't need China really for anything, but our main products out to China are ag products and then aircraft and engines. But ag products are a real major part of what we sell them, and then they sell us a ton. If we look at what's gone on recently, and this list is a good list, we pulled this from Bloomberg, the shipping levies that China was trying to put onto our ships, which kind of started a little bit of heat about 3 weeks ago, soybean purchases, fentanyl, export controls, rare earths, big, that's going to be the topic I really want to talk about. And then we had the threat of additional tariffs, and Trump in true Trump fashion, just said, we'll just put 100% on top of you. We'll go right there, no problem. And the TikTok deal. There are some bigger elephants in the room here. For me, fentanyl is one. I know there was some agreement there this week, but fentanyl is a big one. Taiwan is a big one. And for me, and it goes right to Russia, Ukraine, the purchasing of Russian oil against the sanctions that we have in place, which is actually funding Russia to a large degree. We had some conversations with India about that as well. But as far as China goes, getting them to commit to not buying energy from Russia, kind of turn the spigot off for Russia and squeeze them out of that conflict or that war. So there's a lot going on here. The first thing I want to ask you about is how big is this soybean agreement that they came to today? And do you have the details on that? Because I do not. I know that they agreed to buy more and to stop their boycott of U.S. soybeans.
So the soybean thing is huge for a couple of reasons. The first of which is just the sheer size. And I know Scott Bessent was on talking with Maria Bartiromo about that on Fox Business. But it's coming at a really opportune time for American farmers because okay, we've had like chronic agricultural surpluses in this country for what, a century and a half, but it's actually been pretty bad recently, and so you're looking for some price support for a lot of those farmers, especially since they had been planning in anticipation of China actually fulfilling previous agreements, which they never did.
Okay.
So the surpluses have actually been worse than usual, which has been putting more pressure on those farmers. They've been taking losses in some instances on like whole crops. So the fact that we were able to secure something right now is a huge, huge win for a lot of those, for a lot of those Americans. And like I said, Scott Bessent was on. We can go to that clip
Oh, let's
where
go to that. Yeah, let's go to that clip because he had some details there on it.
exactly.
Possibly as soon as next week. And Maria, one of the big parts of this agreement, and I'm going to break the news here on your story, is the massive amount of agriculture purchases that the Chinese are going to be doing in this agreement. So the Chinese have agreed to buy 12 million metric tons of soybeans during this season, right now, between now and the should be January, and then for the next 3 years, they're going to be buying a minimum of 25 million metric tons per annum for the next 3 years. What I would expect is, as President Trump did in 2020, after President Xi had agreed to the Phase 1 deal, he called him regularly and got him to buy more, and that number went up much higher.
And Anthony, you had said 70%, right, of our soybean export goes to. See, I knew it was more than 1%, but I wasn't sure, exactly where in there.
Yeah. China, one of the largest consumers of ag products globally for us. Soybean, massive, poultry, and corn, very large, very large consumers there, and we need that. It's. I hate saying we need it because I do believe, I've always believed, and I've always said, and I think you've agreed, that we hold the cards at the table in this trade negotiation with China. When it comes down to it, remember, we are the largest consumer in the world. We are the greatest economy in the world. And China's economy is not humming along the way they would like it to. Over the past couple of years, they have pumped hundreds of billions, over trillions of dollars in stimulus into the economy, whether they're trying to support commercial real estate, whether they're trying to support the capital markets, the equity markets, or the banking system.
Right.
They are not running along like all is well. They're running a balancing act over in China, which is not spoken about too much, but it is the fact. And you can remember back even to the 21 bear market, as we headed into 22. There was a regional banking crisis here, and we saw about a 28% drawdown in the S&P. But a lot of the fear that started there, and then we had Russia, Ukraine, we had a lot going on. Powell got confused and started to spike rates up at 75 bips at a time. A lot of things happened, but hey, it was college, right? But
6 years of college down the drain.
But I would say that even at that time, the commercial real estate was imploding in China.
Yes,
and that bug has not gone away. They may have
Mhm.
covered it up. They may have shifted the headlines. They may have funded some of it to calm it down, but they're not in great shape. So, as far as a consumer of our ag products, yes, they are a large consumer of our ag products. Would we like to have fair trade and be selling to them? Of course. But the fact that they stepped in and they stepped up at this point, as Scott Bessent just said, 12 million metric tons for the balance of the year, and then 25 million metric tons per year at a minimum over the next 3 years. That's significant. That's pretty good. The other item that I really want to go into, and I would love your opinion on, is the rare earths. So we have a chart of rare earth production. And this for me is a really big deal because Trump has talked about it for a while now. China tried to pull the card and really negotiate hard on it and basically said, we'll just limit our exports of rare earths. If you look at this, you can see that is a real threat, right? China is producing 70% of global output. Now, if we really need these materials to move forward with technology, with development, with the modern economies, that's a big deal, right? So here's my take on it. And then I really want to know what you think about it. And this is just broad top-down opinion. China pulls this card. So Trump says, okay, no problem. I'm going to sign a deal with Australia. I'm going to come to Malaysia. I'm going to sign a deal with Thailand. I'm going to sign a deal with Cambodia, all in rare earths. Oh, and by the way, I'm doing this in your backyard. So now I have 4 to 5 allies who are now going to be, who are producers of rare earths, who are going to sign a contract with the United States to provide to us. So actually, the card you just pulled is not as big of a card as you thought it was. Oh, and by the way, we're in the PAC Rim. We're in APAC. So we're right in your neighborhood. We have allies here. Countries that we normally would put boots on the ground and be there in a military presence, we've now entered into an economic deal. We're building economic partners, which is almost an implicit security blanket for them, because we have assets there. We'll have American citizens there. We'll have a presence there that's not necessarily military, but please do not come in and hurt any American citizens or our interests. We have a right to defend them. I think he created a massively insulated pocket there. He did it in a very calm, strategic, and economic way, but essentially put a stake in the ground in quite a few countries right around China and took away one of their biggest playing cards. What do you think about that? How do you think this plays out, and what do you think of that?
Well, Anthony, you're spot on there.
Awesome.
I mean, basically, what we just saw was, China was. I mean, it's like they were going to cut off their nose to spite their face. They rely so heavily on this export market for rare earths to generate income for their country, and in part to fund all of the crazy stimulus that you were just talking about a minute ago.
Yep.
So, it was never really tenable. It wasn't something that they could actually practically implement. All of a sudden, shut off the spigots to the rest of the world. But what it did do was frankly just tick everybody off. And all of a sudden, everyone was like, you know what? We don't want to do business with these nutballs.
Yeah.
We'd much rather do business with the United States.
Yeah.
And so that I think is in part what we're seeing. What's the Sun Tzu line? Something like never interrupt your enemy when they're making a mistake.
Yep.
I mean, Trump basically just let China shoot themselves in the foot. CCP kind of took the mask off, showed everyone we're not trustworthy,
Yep.
even less so than people thought.
Yeah.
And you're right. Now Trump is inking all of these different deals, across the whole Pacific. It's really incredible.
Yeah.
And the other thing is that the more and more we see countries like China try to shut off the mining in terms of these rare earths, which is what you're seeing on this chart here, the more I think you're going to see recycling, and not like the garbage kind of recycling where, you throw something in the recycling bin and odds are it just goes to the landfill anyway, or
Sure.
it gets burned or whatever. No,
Yeah.
like there's actually a lot of stuff that is genuinely recycled.
Yeah.
Things like catalytic converters, things like batteries. A lot of this stuff, it's typically worth it.
Yeah.
To get these rare earths back out. And it's not because they're rare. That's kind of a misnomer that, a lot of people think like, oh, there's just not a lot of this stuff. I mean, some of these rare earths, Anthony, there's actually more of it in the earth's crust than there is things like copper. So this idea that there's not a lot of it, it's just a fiction. But the problem is, it's not like if you find, let's say you find a coal deposit, right? It's hundreds of feet thick, maybe. It's miles long. And when you get to it, it's just solid coal. You just keep digging and digging, and it's nothing but coal. When you find rare earth deposits, it is spread out, almost like diffused. Imagine you take like a salt shaker, you dump it out on the table, and then you just shake a pepper shaker a few times, and you want to get all the individual pepper flakes out of that giant mess.
Yeah.
You basically have to process the whole thing.
Yeah.
And just get that small quantity out of it. So like we have plenty of rare earths here in the United States, but because of bad tax and regulatory policy, it's too hard to get to it. Yeah. Russia has a lot. There's several places in Africa that have a lot that they're not touching. There's even a couple places in South America too. So what I'm I guess I'm trying to say here is that the more we get off China here, the better. And the more we get reforms here at home that allow us to get to our own supply, the better. The more we can, get friends and allies to do the same, the better as well.
Mm-hmm. Mm-hmm. Yeah. Awesome. I'd like to shift gears and go to gold. Ascalon 6 has a very, very concentrated portfolio in the future space. We're S&P Russell, we are crude oil, front month VIX, and gold. We've been out with a bullish signal in gold, obviously, in December, late December. We actually had a call out at 2,600. You and I have gone through this to be long gold on a very significant breakout. Excuse me. And recently we've seen not massive, but an aggressive pullback. So we got up on the front month to around 4,400. And we have this chart to pull up. We got a front month gold futures around 4,400. And then we pulled back on a pretty significant, almost a 12% pullback to around 3,900. What's interesting about this is the longer term, and I did a quick hit about this out on X, the longer term signals for gold for us at Ascalon 6 are still bullish. So on this pullback, you start to look at it and say, well, figure out where this thing is going to kind of end the drawdown, or is this a bigger deal than we thought? Well, the fundamental story is still the same, right? We still have massive amounts of debt and inflationary pressures globally. Real rates are still below 2%, even though the 10-year is up at 4.1. Real rates are low, and there's still a pretty significant amount of economic and geopolitical risk out there, in addition to the fact that we've had a ton of sovereigns buying gold in an effort to move away from U.S. treasuries and away from the U.S. dollar. So the fundamental story is there. The longer term ACAP signal is bullish. So then you say, okay, so what's the trade? Well, we did get a negative signal on gold a little while ago, late in the move, I will say. But we did pull back. I noticed the other day when I drew this chart up, and it's a little better now than here because we're a couple of days out. But we did hold right around the 38% retracement. So if you run a retracement from, call it like late July, right around the 3,300 level, there was a pretty good consolidation there. We ran up to 4,400, run our retracements there. My point coming out of that was at 39.85, just about 4,000 is a 38% retracement. We had started to break back above 4,000 there. And my point is, the trade at this point is to be long gold above 4,000. I don't think this story's changed. Longer term technicals are still in place. The drawdown obviously was a shift out of gold and kind of some profit taking. It was definitely a push out, but essentially held where we needed it to hold. Mm-hmm. So the trade for me in gold is long gold above 4,000. On a stop, I would be out of those longs below the October 28th low, which is 3,900.
Okay.
Front month contracts right now at 4,050. I would be a buyer of those personally. The ACAP model would be a buyer of, has a positive signal now on gold at 4,050. And I would expect a run through the prior peak at 4,400 and towards 4,000 over the next 6 to 12 months. I could easily see that being the levels we see. So a buyer of gold here, even though we've had this drawdown. If you held on, do not sell them here. I would be a seller below the October 28th low at 3,900. But right here, I think this is starting to become constructive price action. I don't think the sell-off is any deeper. I think we saw the lows the other day. And I think gold has more room to run to the upside. So that's my view on gold for today.
Yeah, how much do you think, with Powell in his press conference, he really tried to, it seemed like, emphasize, like, look, the December rate cut, nothing set in stone. Don't be too hasty in thinking we're going to automatically cut rates again. Mm-hmm. So obviously, tighter monetary policy, that's bearish for an inflation hedge like gold, right? Yep. Do you think a lot of the move then had, after his comments, obviously, yep, had to do with that hawkish stance, or do you think that was another case of headlines interchangeable?
Yeah, I think the headlines are interchangeable. The gold move is so much bigger than the Fed at this point. I think, not to be personal about it or disparaging, because it's not my nature, to be honest. I joke, but I don't think that I think Powell has all but kind of disqualified himself from consideration. Although he thinks he's controlling the market, he's not. Yeah. Market's obviously focused on the Fed. There we go. This is actual video of Powell driving for the last meeting, by the way. No, I'm just kidding. funny.
Mr. Magoo, you've done it again.
You've done it again. I think the move is bigger than Powell or the Fed. I think, again, the pressures, the fundamental story doesn't have to do with Powell or his statement or if the Fed funds rate is going to be 25 bips higher, 25 bips lower. I think it more has to do with the inflationary pressures, geopolitical risk. I think it has to do with the dollar and real rates. And I think it has to do with the push out of the dollar and out of treasuries and into gold. It's been a significant real move. And we know that, especially by the sovereigns. So the momentum is still there. The move is still there. This was an aggressive move down, but we've had an aggressive move up. We've been slicing through the upper Bollinger Band in gold since August. I mean, we just continue to grind into it and grind into it and grind into it. And a lot of people look at the Bolly bands as, when you start to get through the upper band, you're extended, you're going to come back down to the average. And then when you break through the lower band, you're pushed too far, you're going to come back up to the average. That's not how they work. And that's not how I view them. When you see price action aggressively moving through the upper band and the bands are widening, meaning volatility is expanding and price is going up, you're going up. And that's where you're at. So I think that the story is just bigger than Powell. I really do.
That's such a great summary. I'm so glad you were able to articulate that so well, Anthony. The way those different metrics work and how how people so often misinterpret those signals. So I know, like on a fundamental side, like policy side, I guess maybe is a better way to put it. It certainly seems like gold is not a bubble. It certainly seems like there's a lot of solid reasoning behind this kind of price action, and that this isn't some kind of bubble where you're going to end up with a massive correction, right? And I assume it sounds like that's what the technicals are telling you as well, right? That this is not some kind of like a tech bubble or .com bubble or whatever. This is the real deal. And we are not anticipating some kind of, a 50% correction back to 2000, right?
I would not see that. I do not see that right now in the technicals. There'll be corrections, there'll be consolidations. And as you zoom out and you start to go from daily charts and weekly charts to monthly and quarterly charts, you'll see consolidation in gold. It's not going to obviously, and I know you know this as well. We've spoken about this. It's not going, vertical for the next 10 years. But I don't see it as a bubble as you would in tech stocks or in AI stocks potentially, or .com stocks. Like, I just don't see that right now. Technically, fundamentally, you can make the case that it's not the same either. But from a technical standpoint, it is lined up bullish. It remains lined up bullish within that move. We're going to see smaller trades and smaller moves up and down, and some consolidation and some profit taking and some shifting. But overall, no, I don't see it as a bubble. Could it become a bubble? Absolutely. There's zero question that it could, and that could get into who's buying. It could get into ETF buying and derivative trading and all those things. Capital markets get crazy and people.
It's a great point.
But right now, from what I see, not a bubble, in a bull move, and continuing to grind higher with solid fundamentals and solid technicals. So keep an eye on it. It's one of our 5. And it's one that's performed very well on the model. So we will definitely keep an eye on that. EJ, always a pleasure, my man. I appreciate the time. I will be down to DC actually in the next couple of weeks, so I will hit you up for that. But as always, appreciate the insight and look forward to chatting again soon.
Pleasure's all mine, Anthony. Till next time.
Thank you, everyone, for joining. This is Policy and Profits with EJ Antoni and Anthony Esposito. If you care to find me on X, it's at CMT_Anthony. You can go to the website. It's ascalon6capital.com, or you can email me at anthony.esposito@ascalon6capital.com.
You can find me on X. The handle is @RealEJAntoni. See you next time, everybody.
Talk to you soon.